maybe like take it easy. Welcome back, Peter, my trading warrior brother. How are you?
Great, Dale. I'm really good, thanks. Yeah, how you doing?
Great, man. It's kind of feels like a lot of things we're talking about. We're at some inflection points, and what great timing to have you on. I'm just like Stelio said, he wants to hear you. What's your narrative? What are you thinking here? What's center on your radar right now, Peter?
Well, what's on the radar? I suppose really
Share
from
your
a
screen,
slightly.
please, buddy.
Oh, sure. Yeah,
Yeah.
let's do that. Yeah, let's do that. Yeah, that's a good idea.
Some of your accounts.
Yeah. Okay, that should. Oh,
Okay,
I've got the wrong
there we
screen
are.
active there. Hang on a thing.
Okay,
Let
that's
me
a big call.
Yeah, that was the dollar, wasn't it?
No, that was S&Ps.
Oh, okay, that was the right screen. Okay, let me just do it again. Okay, so can everybody see my mouse hovering around here?
Yes. Yeah.
Okay, that's the right screen. Okay, yeah, good. Well, I think the bigger perspective, one of the things which became very evident at the beginning of October was that we were just pulling down from September's highs into a correction on the main indices, the S&P, Dow, whatever, the Nasdaq, and that we were going to get a higher high. And we were talking about at the time around 5-7% up from that low. And we haven't quite made it to the top yet. We've got a little bit more of a nudge coming. But the big take home that's really fascinating me is that when I look across all the asset classes, we can see a major top coming for the S&P up here. But it's also recurring, in the 10-year Treasury yields, 5-year yields. We can see a sort of a very similar play in the currency side, particularly dollar yen. If you want to match up the dollar yen pattern from the pandemic low right up until where we are today against the US 10-year Treasury yields, that looks very, very similar pattern. But they basically are all giving us a very, very concise idea that once we get a little bit higher into December, everything's going to melt down. And I personally think that we're going to see quite a big shock. I don't think it's on the radar. The amplitude that I'm expecting to the downside is not really on the radar, apart from the perma bears that that you hear about day to day almost. But aside in the rational world, where we're looking at sort of risk reward in percentage terms, month on a month basis, I don't think anybody's really talking about the type of decline that I'm working with now. The reason for it is, in a way, it's Elliott based. So people tuning in today, if you're not Elliott wave based, I'll explain just a little bit here. When we take a look at the post-pandemic advance, I'm just going to put my tool into red so that you can see it better. When we take a look at the post-pandemic advance, the rally in the S&P, as is quite a few of the major stock indices, particularly in the US, some in Europe, they're unfolding into 3 waves like this. There was an initial 5 price swing subdivision up here into September last year. And the clue that this is a zigzag pattern, a 3 price swing event, is a very simple measurement. Just extend the first upswing, the first 5-wave upswing by about 61.8%. And if you get a successive 5-wave pattern coming up that follows it, that's in or around that sort of extension number, that's pretty much a good idea to define a zigzag. Now, why would a zigzag be unfolding in a new uptrend? Because basically the pandemic low was an intermediate 4th wave correction. If we go back to this chart, this is a weekly chart from the financial crisis lows. We've got a bigger 5-wave pattern development here. So the question is, when the 5th wave begins from the pandemic low, why are we getting 3 waves? Surely an Elliott wave model should be a 5 price swing event like this. 1, 2, typically 3 is the largest wave. You get 4 retracement and 5. We should be looking at something like this developing as the 5th wave. Well, the reason is because it's not an expanding impulse pattern where you get a typical 3rd wave extension like this. This is unfolding into a diagonal impulse. It's still consisting of 5 waves, but it's in a wedge-shaped formation. And if we take a typical look at that, let's go to wave search and have a look. Impulse diagonal ending contracting. This is it. It looks like this. So you have wave 1, 2, 3, 4, 5. It's in a wedge shape. And the subdivisions for an ending type diagonal, this is where it's either a fifth wave, for example, in a 5-wave pattern. The subdivisions, hey presto, look like zigzags, A, B, C, like this. So basically, what we've done in the last year and a half, since the pandemic low, is move up in a zigzag like this, and that becomes wave 1 of an ending diagonal. And the prerequisite, therefore, for this diagonal pattern to evolve is the second wave is a big correction to the downside. So when you take a look at, let's put big price ratios in. When you take a look at the archetype, second wave correction, it's normally a very deep 76% retracement. So it's a real shocker if that comes through.
Do you have I know you're not Nostradamus, but I know you're a thinker, and you're talking about shocks. What I'm seeing on the news, what people are fearing right now is, I know in Europe, you guys probably think we're babies, but people are complaining about $5 gasoline. And that's all we see on the news now is, inflation is everyone's main concern. If we get this risk off move that you're looking for, are commodities going to be under pressure? Notice that maybe copper might be topping up here against gold on the ratio. Greg Horvat showed that chart. What do you think happens to inflation hedges during a sell-off in equities?
Well, absolutely. I think the sell-off in equities will undoubtedly bring a lot of these commodities downwards. Now, we just saw those CPI numbers come in. Here's the latest data. It's already gone in at 6.2. I mean, this is really big. But look where look where the biggest the biggest component gain is gasoline. Look.
Yeah.
Now it peaked here in May, 56%. But that's really huge. And I think gasoline, but also if you put in energy as a whole, as a general energy move, it's still very large. You got here 28.5% in May. But
maybe
yes,
Putin invades. There is concern about what he's massing on the Ukrainian border again, and he has a lot of leverage on Europeans right now. In fact, the whole world with bottlenecks in energy. He supplies Europe with all their nat gas, right?
Yeah, well, I mean, I was just reading a report about that, and they were saying that actually the flow has really gone basically reduced into the pipelines through Europe, through Ukraine, and then into Europe by about 45%.
Wow!
And that's
it's a
that's
big number.
Really, yeah, it's a huge number. I had a look at gasoline because I don't track it ordinarily, but because of the whole inflation aspect story, I decided to take a look at gasoline. Okay. And fascinating story because this is our RBOB gasoline prices. And if you go back to the pandemic low here, you can see a very succinct 5-wave pattern. So from an Elliott perspective, 1, 2, 3, we have a bit of a sideways correction there, 4. And we just need a bit more for wave 5 to complete. And then next year, I think we're going to get this.
Wow.
We're going to get a big drop. So that means
the Fed will be able to say they were right about transitory.
Yeah, absolutely.
That's really interesting.
Yeah, I mean, these guys are bungling around, aren't they? I mean, let's face it, the Fed are as far behind as the tail of Taylor's comet. I mean, it's ridiculous, I mean, but they're going to end up being right, which is ironic, really, because I think, yes, we're seeing these exact inflation pressures exert through gasoline and crude oil. Well, let's take a look at crude because, again, while I was talking about the inflation story, let's have a look. And you can see that on crude oil, we haven't got a top yet. We've got to push up a little bit higher into December, I think.
Okay.
There's a shorter term diagonal pattern in here. It's a 5-way pattern. It's a bit like this. But so it's not quite finished. Maybe not down on the downside.
So and look at Peter's downside targets for the fall next year.
Yeah, this is where we're going to get to. We're going to get. This is only a 38% correction on a logarithmic scale, but it's a 60% drop in price.
Yeah.
I mean,
Okay, interesting.
that's huge.
And while this is going on, the dollar rally terminates. And will this surprise people? Should your wave count be right in the S&Ps that this time, should the S&P sell off, the dollar's not going to get a bid as a safe haven currency into next spring or summer?
No, I don't think it will. I mean, I think the dollar generally this year, here's this year's low in January, and it's been moving up in what we describe as a counter trend double zigzag pattern. We've got to get up to about 96 figure, somewhere up here. This is the 50% correction area, and we haven't quite finished yet. But I don't think we're going to see the dollar as a safe haven. I think we'll probably see the safe haven currencies like yen and Swiss franc. I think they're going to dominate the safe haven scene. But this time around, I don't think so. I think we're going to go through a dollar crisis next year, because basically we've been topping out on the 15.6-year cycle up here at 103.80. I've got a long-term dollar cycle to show you actually today. For those that haven't basically seen our work before, we do publish twice a year some really long-term forecasts. And we put a lot of cycle works in. This is coming from our mid-year report. And it shows that the dollar's generally in a decline until about October 27. So we're basically sort of continuing to decline in this cycle period at the time. But it's long overdue for a bigger collapse. And we've been building baby steps to the downside. Here is the 15.6-year cycle top. We've had 5 waves down into 2018. It took, incredibly, almost 2 years to go up here in a second wave correction, and then collapse in 5 basically into January this year. And at some point, this is going to collapse. I think we're coming into that now. So I don't know what's going to trigger that necessarily. We can, make up some hypothetical reasons for that. But I think generally speaking, we've got to be thinking in terms of what is going to cause a dollar, basically a risk-averse dollar, and a dollar, basically a dollar run. I think we're going to have a confidence loss in the dollar as a benchmark global currency unit. Okay,
so maybe the economically sensitive commodities sell off, and the debasement hedge. I've heard the dollar be described, gold being described as a better debasement hedge than inflation hedge, because it follows more of the movement of the dollar being debased, whereas crude was a better guideline for inflation. Do you agree with that?
Yeah, I would, because as we saw from the CPI numbers, the chart just now, the all of the CPI inflationary aspect is really built into energy. It's not food. Actually, the food component is lower than the composite, which today was 6.2. So you've really got it's really the energy aspect. If you can predict energy prices over the next, say, 6 months, you pretty much know what inflationary pressures are going to be around.
Okay. So we'll be able to get gasoline, but not be able to afford a steak and beans and corn. Are you tracking the grains at all, Peter? I know you cover
not really.
so many.
No, I'm not really.
All right, because I think there's going to be a problem with maybe food security. Maybe not as much in developed nations, but I think that's a possibility.
Well, I do see that from our institutional clients, because a lot of them are family offices, and they're all buying a lot of land at the moment to grow food. And
farmland.
Like farmland, yeah.
Yeah. All right. So we could set up an office in the barn. So anyway, Peter, we're getting a couple of requests, and I'd like to help people that that stuck around to hear you, because they've seen your work before. So your take on metals, gold and silver.
All right. Okay. Yeah, sure. Well, gold, let's talk about timeframes first of all. By and large, what we've seen since August, sorry, that's 10-year yield.
Wow, look at the 10-year yield's going to 6 in 5 years.
Well, yeah, we can come back to that in a minute. All right. Where am I? Oh yeah, gold. Yeah, let's take a look at the bigger picture. Now, the August 20 gold decline, this is correction.
Yeah.
And The only question that I'm asking myself, well, you see gold's just breaking 1834.
Okay, it's doing it now.
So it
All
looks as if we're going back up to, we're going to reach basically, I think over the next months, we're going to get back up to about the highs up here. And once we trade up here, we might pull back in again as this drops. And I think this is all about inflation aspects. One of the curious things that I've had is that, you know, back in the late 70s, I was trading silver and gold at that time.
Yeah.
So I was really in the thick of it with the bunker hunts,
yeah,
and the the bunker hunts, buying silver like crazy because they saw that as an inflation hedge. I think what's curious about gold though is that it hasn't really fired up, you know, in this inflation environment. And given the fact
that Blake thinks it's because of the flow of money into crypto. It's competition for gold.
I don't know. I'm not sure. I think the new era of cryptocurrencies. There's a lot of young people, you know, 40 under the age of 40 who are trading crypto, and no, I just don't. I think that's a new generational thing.
Okay.
I mean, it's very volatile and it tracks. Look, currency trading has exploded over the last 10 years because if you trade with a broker, he's going to give you very good margin against your deposits, right? And that's why it's exploded. And it's really in a way a similar thing because I mean, it's a huge percentage game, isn't it? It's a casino, really. It's not a currency. It's a commodity, really. You can't really call Bitcoin and Ethereum and the others currencies. I mean, can you tell me any other currency around the world that fluctuates like that? No, you can't. Not even something from, you know, not even some of the third world currencies, you know, trade that with that amount of volatility.
The Argentine peso every once in a while.
Maybe, yeah, good, yeah. Maybe the Turkish lira.
Different colored money too. So, okay, so silver, please.
Silver. Basis this, we've got. Here we go. Silver, we've got basically a bit of a triangle pattern. Goes back to the same August 20 high. So we've got basically range trading. We've got this breaking up. We've got a 5-way pattern developing from this September low. And we need to get the 5th wave up to about 25.16, and then we can pull back a bit, and then later in the year, maybe into the year, we'll get up to, I think 27.36 is reasonable. Somewhere up there. But we're range trading there. I don't think we've got an imminent breakout like this. So
the gold silver ratio would during this stage for the next 3-4 months favor gold over silver.
Well, it's favoring silver a bit at the moment because when we were dropping down, you see, I mean, basically the gold silver ratio moves alongside it's more or less directionally input. So I mean, if silver's declining, the gold silver ratio will widen. So here we widened out completely. And now that silver's recovering a bit, we're actually seeing silver outperform slightly, and it's narrowing the spread. I mean, the long-term spread on this is fascinating because I've completed some analysis a couple of months ago on this. I'll just show you quickly, but it's pretty neat. Let's take a look. Gold silver ratio. I think I've got it in here. Not that one.
Okay, wow. Yeah, because 40 used to be the mean, kind of
the mean. Yeah, this is it here. I mean, this is going back to 1930s, but when you take a look at this long-term picture, you've got this huge 5-wave diagonal, finishes here. So this is basically the end of the era where silver is, you know, basically is trashed. So this was the low basically around the pandemic low. Since then, we've traded down 5 waves. We're rallying. But you know, really in the long term, you don't want to be buying silver. You want to, you don't want to be buying gold. You want to be buying silver, you know, because the spread's going to narrow.
Right.
So
same thing with the shares.
Yes, the gold miners look pretty strong. I mean, I think they're going to be outperforming GDX. Let's have a look at that. Because I think we've still got some pretty big numbers coming through on GDX. up here to about 100, over 100, into new record highs, basically.
Yeah.
And we've
Yeah,
just
that's a big
finished a
move.
correction down here. So, you know,
Yeah.
last month was the bottom. You should be buying this stuff really now.
Yeah. I remember, so you know, you made a long-term forecast, so I remember some things that you were looking for, like 2780 was going to be a long, so you know, from a year out, you were a point off on GDX for a buy point. And you always readjust things, so you know that's you have to. I mean, everything changes, but that was a nice call. So yeah, buy gold shares and just go to sleep for 5 years.
Yeah, you don't even need to leverage, do you, when you've got multiples
Yeah.
like this? You know,
Yeah.
I mean, I've I've looked at the you know, the nugget. This is the 3 times bulls thing.
Yeah.
You know, you can look at that if you really have got, you know, if you really can watch it day to day and, you know, keep an eye on it. But if you can do that, you can leverage even in these things. So, you know, they represent huge upside potential, huge upside potential.
Yeah, and you know, it looks like it's going to go kind of hand in hand with your dollar cycle into, you know, 2025, 6, 7, like that.
That's right. Yeah, I think the dollar will assist. I mean, when you had some questions just now, were people asking about copper prices or anything like that?
No one asked, but I'm interested.
You're interested. Okay, yeah, we'll just have a quick look at copper because, well, actually, one of the things that's really, I mean, there's no doubt about where we're going to in the bigger picture. I mean, let's take a look. Here we've got copper.
Okay.
In a consolidation phase. It's
Right.
a 4th wave. And
yeah, it made like
I
a
think
little double top, but it's still got plenty to go.
we've-
We have an interesting question here from David.
yes,
Will the gold miners be unaffected by the risk-off move in S&Ps and Nasdaq and Dow?
yeah, I think they will be unaffected. It's a good question because we were thinking exactly the same. And my impression is that that gold, as soon as interest rates top out, which they should at the same time, that's long dated interest rates, I must add. But the long dated interest rates, I mean, like 10-year treasury yields, for example, or if you're here in Europe, you trade the bund yields. But they should start turning down from a peak in December, the same time that equities and commodities start to fall. But it's quite evident that if we start then looking at a dollar decline, okay, dollar won't be safe haven. This is a misconception because we're hot wired into thinking that the dollar will be attracting safe haven buying. It won't be this time around. I think we're going to see a complete opposite. The dollar's going to be declining. That's going to help gold very much. But the other tailwind for gold is, of course, lower interest rates. And if our inflation expectations are going to be that they're all going to come off next year, gasoline prices dropping down, oil dropping down, 10-year yields dropping down, then of course that's a very good tailwind for the gold stock. So yes,
and a big decline for U.S. dollar yen.
Yeah, well, that's right. And I was a bit slow on this one, I have to say, because on the uptake, because I was looking at dollar yen. We had targets originally earlier this year in January at about 121, and when the yen was weakening relative to the other major T10s, I thought, great, this is looking good. We're going to be we're on target up to about 131, but 121 rather. But then as the year has progressed and we haven't ascended into the same trajectory as we did at the beginning here, I realized that this upswing was developing exactly the same as the 10-year yield. It's a zigzag, A, B, C. And we're just hitting some targets today, actually, I think. And we should be, I think we might end up range trading here for another few weeks before we end up pushing higher like this. But basically, it looks like most of that downswing is finished. I think we had a target last week.
1272, yeah.
What did we get to today? 72. Okay, it wasn't too far off.
Close enough for government work.
But exactly. But look, this is what's going to happen. So the dollar will sell off and the yen will go bid, and it should pull us all the way back down to about 103.
Wow.
Something like that.
Beautiful long count. So, here's something else that's a little bit, counterintuitive. Khalid saying that you're projecting a 10-year yield to go to 6% and gold to an all-time high. Did I get that right?
Yeah, I think so. Because don't forget, we're talking about all-time highs a few years from now. Okay, so this is not tomorrow.
Right.
So
And
when
these
you
are
talk
6% yields. Aren't you looking for about 210 and then yields to come off again?
That's right. I'm just going to get the because I was updating these just yesterday actually, because I'm typing up a report for the moment specifically on the outlook for yields. Let me just show you the because yeah, let me just get this right. Where are we? Here we go. Okay, 10 years. So this is my new 10-year yield chart. That we go up to 2% by December.
Yeah.
Then we're going to drop down to about 87 basis points into the first, probably the first 6 to 8 months of next year. And then after that, into the final phase of what I call the inflation pop, where, this is the culmination of inflationary pressures that we're currently seeing now. That should last for the next 2 or 3 years as well. Then we'll get 10-year treasuries up to 5.6, and that should coincide with gold probably getting up to about,
and the dollar bottoming.
And the
at
dollar
50.
Dollar bottoming at
If
50.
it exists. Do you think it'll exist?
Yeah, of course it'll exist. Yeah.
Will it still be considered a reserve currency at 50 in the Dixie?
Maybe not.
Yeah. Okay.
Mm-hmm.
So
and that will be gold about
United States we become like a third world country, or like Germany and the UK.
No. Yeah. Okay. Yeah. You could feel it feels like that sometimes, but no. Oh God.
Or Greece.
No, we won't be. We won't be going that far. But I mean, I think that I think the US will lose its status as a. Yeah. I think we're going to see other currencies come to the fore by that time. Yeah.
Okay, it's good. And China.
Well, China, I mean,
could that be the black swan, Peter? Because I know we're out of time, but back in 2008, they were the engine of growth to pull us out of the recession because they didn't have toxic paper, and they were still going to grow. And what the path that Xi is on, maybe he'll cool it until after the elections. But the deleveraging in China, if China could pull us out of a recession, can't it pull us into, maybe that's a black swan that could get that level down to 2,600, something out of China?
Well, I mean, I think that China still looks okay. I mean, look, if the Shanghai Composite was going to be collapsing lower or something like that,
yeah,
in some sort of black swan event, you'd see the Hang Seng collapse. And there's no doubt in my mind what the Hang Seng picture is. I mean, that's moving up. Like most indices will be doing in the next 2 or 3 years. So we're not hitting major tops at the moment. We're hitting interim tops. I think that this looks good for a move above into record highs. So this is really sort of, if you look at the BRICS index as well,
it's a triple almost. Yeah.
Yeah, if you look at I think this one looks good. I like Russia actually as well. And I was a big fan of Brazil in the last few years, but I've noticed that Brazil, whilst it could double after a correction next year to the upside, there's lots of other things that you could be trading if you want to leverage and get bigger multiples, into the final phase of the inflation pop. But I think China looks okay. I don't think it's going to. I don't imagine it being a black swan, because I think that would come up in the Hang Seng, and that's definitely not what I have in my in my counts on that.
All right. Well, thanks for straightening me out. So, I look, a lot of people stuck around for the interview. Peter, how could they follow you? And you were talking about you're just writing a report. So how they get in touch if they're interested in continuing to follow you?
Well, great. Thanks, Dale. Yeah, listen, if anybody would like to follow what we're doing here at WaveTrack International, then I'm typing up a report for tonight. We publish twice a week, so I'm doing it today for tonight's publication, and I'm also on Friday. We do that each week. And you can subscribe. It's called the Elliott Wave Compass Report. If you go to wavetrack.com, here's our main website, and go to subscription. Just click on subscription here, and Elliott Wave Compass, and here it is. It's $39 a month. And we have quite a lot in there. We pack quite a bit in there. And you can see that we cover stock indices, bonds, currencies, and commodities. Out of the main commodities that we do there really is gold, silver, and oil. And on the currencies, we do about 6 out of 10 on the G10s, and we alternate a bit there. And this is a really great way to follow what we're doing. Yeah.
Okay, Peter, thank you so much for sharing long-term counts that people can remember and have biases for. And I appreciate you having a giving spirit, edifying the F.A.C.E community today.
Great, thanks, Dale. Thanks for inviting me, and it's God bless everybody. Yeah.
All right, man. Good hunting, Peter.
Thanks, Dale. And to you.
All right, that's a wrap, everyone. And have a great day trading. You could join the team in 11 minutes for the morning edge. Adios, everyone. You're very welcome, Anthony, Brock, Monica, and thank you again, Peter.
Hey traders, this is Blake Morrow with ForexAnalytix. Thanks for stopping by our YouTube channel. Don't forget to like these videos, share them, and subscribe to our channel so you don't miss any of the content that we provide here for free. Thanks for stopping by. I'll see you in the next video.